Question 1. Which of the following describes the role of a transfer agent? A. Acts as a custodian for client securities and funds. B. Maintains records of stock and bond owners, issues and cancels certificates, and processes dividend payments. C. Facilitates the trading of securities between buyers and sellers on an exchange. D. Provides investment advice and executes trades for clients. Answer: B. Maintains records of stock and bond owners, issues and cancels certificates, and processes dividend payments. A transfer agent is responsible for maintaining accurate records of who owns a company's stocks and bonds. They handle the issuance and cancellation of stock certificates, ensure proper transfer of ownership when securities are bought and sold, and distribute dividends or interest payments to shareholders and bondholders. This role is crucial for ensuring the integrity of ownership records and facilitating smooth corporate actions. Question 2. A customer who wants to open a margin account must receive which of the following documents? A. A copy of the broker-dealer's latest financial statement. B. A new account form and a margin agreement. C. A prospectus for each security to be purchased on margin. D. A suitability letter from the registered representative. Answer: B. A new account form and a margin agreement. When opening a margin account, a customer is required to sign a margin agreement, also known as a margin account agreement or customer agreement. This document outlines the terms and conditions under which the customer can borrow funds from the broker-dealer to purchase securities. Additionally, a new account form, which gathers essential customer information, must be completed to establish the account. These documents are fundamental for both compliance and transparency regarding the risks and responsibilities associated with margin investing. Question 3. Which of the following is true regarding the tax treatment of interest income from a general obligation municipal bond issued by the state of California and purchased by a California resident? A. It is subject to federal income tax, but exempt from state and local income taxes. B. It is exempt from federal income tax, but subject to state and local income taxes. C. It is exempt from federal, state, and local income taxes. D. It is subject to federal, state, and local income taxes. Answer: C. It is exempt from federal, state, and local income taxes. Interest income from municipal bonds is generally exempt from federal income tax. Furthermore, if an investor purchases a municipal bond issued by a municipality within their own state of residence, the interest income is typically also exempt from state and local income taxes within that state. This is commonly referred to as the triple tax exemption, and is a significant benefit for in-state residents investing in their local municipal bonds. Question 4. An investor who buys a put option expects the price of the underlying stock to A. Increase significantly. B. Decrease. C. Remain stable. D. Experience high volatility, regardless of direction. Answer: B. Decrease. Buying a put option grants the holder the right, but not the obligation, to sell a specified amount of an underlying asset at a predetermined strike price on or before a specific expiration date. Investors typically buy put options when they anticipate a decline in the price of the underlying stock. This strategy allows them to profit from a downward movement in the stock price or to hedge against potential losses in a stock they already own. The maximum loss for the put buyer is limited to the premium paid. Question 5. Which of the following investment products is typically actively managed and attempts to outperform a specific benchmark index? A. Exchange Traded Fund, ETF. B. Indexed Mutual Fund. C. Actively Managed Mutual Fund. D. Unit Investment Trust, UIT. Answer: C. Actively managed mutual fund. An actively managed mutual fund is characterized by a fund manager or management team making ongoing investment decisions, such as which securities to buy, hold, or sell, with the goal of outperforming a specified market index or achieving particular investment objectives. This contrasts with passively managed funds like index funds or most ETFs, which aim to replicate the performance of an index. Actively managed funds typically have higher expense ratios due to the research and trading activities involved. A unit investment trust, UIT, is also generally passively managed and holds a fixed portfolio for a specific period. Question 6. The primary role of the Securities and Exchange Commission, SAC, is to A. Regulate margin requirements and monetary policy. B. Protect investors, maintain fair and orderly markets, and facilitate capital formation. C. Regulate futures and commodities markets. D. Act as the primary self-regulatory organization, SRO, for broker-dealers. Answer, B. Protect investors, maintain fair and orderly markets, and facilitate capital formation. The Securities and Exchange Commission, SAC, is a U.S. federal government agency responsible for protecting investors and maintaining fair and orderly functioning of securities markets. Its core mission involves enforcing securities laws, promoting full disclosure, and fostering capital formation by ensuring transparency and investor confidence. The SEC's oversight extends to all publicly traded companies, exchanges, brokers, and investment advisors, making it a cornerstone of the U.S. financial regulatory structure. Question 7. What is the primary difference between a general obligation, GO, bond and a revenue bond? A. GO bonds are issued by federal agencies, while revenue bonds are issued by state and local governments. B. GO bonds are backed by the full faith and credit of the issuing municipality, while revenue bonds are backed by specific project revenues. C. GO bonds are subject to federal tax, while revenue bonds are tax-exempt. D. GO bonds are used for infrastructure projects, while revenue bonds are used for general operating expenses. Answer, B. GO bonds are backed by the full faith and credit of the issuing municipality, while revenue bonds are backed by specific project revenues. The fundamental distinction between general obligation, GO, bonds and revenue bonds lies in their source of repayment and security. GO bonds are backed by the full faith and credit of the issuing municipality, meaning they are repaid from general tax revenues and often require voter approval. In contrast, revenue bonds are secured and repaid solely from the revenues generated by a specific project or facility, such as a toll bridge, airport, or utility. This difference in backing directly impacts the perceived risk and creditworthiness of the bond. Question 8. A customer sells 100 shares of XYZ stock short at $50 per share. The stock then rises to $55. To limit potential losses, the customer could place a buy limit order at $45. B. Sell stop order at $45. C. Buy stop order at $56. D. Sell limit order at $56. Answer, C. Buy stop order at $56. When an investor sells short, they profit if the stock price falls, and incur losses if the stock price rises. To protect against rising prices, a buy-stop order is used. A buy-stop order is placed above the current market price and is triggered when the market price reaches or exceeds the stop price, converting into a market order to buy. In this scenario, placing a buy-stop order at $56 would limit the customer's loss if the stock continued to rise beyond $55 by covering the short position. Conversely, a buy limit order at $45 would only execute if the price fell, which is not the goal for protecting a short position against a rising market. Question 9. Which of the following is considered a defensive stock? A. A technology company with high growth potential. B. An automobile manufacturer sensitive to economic cycles. C. A utility company that provides essential services. D. A luxury goods retailer. Answer: C. A utility company that provides essential services. Defensive stocks are typically those of companies that provide essential goods and services, making their earnings and dividends relatively stable regardless of the overall economic climate. Utility companies, food producers, and healthcare providers are classic examples of defensive stocks. These investments tend to be less volatile during economic downturns, offering a degree of stability to a portfolio. In contrast, cyclical stocks, like auto manufacturers or luxury retailers, tend to perform well in strong economies and poorly in weak ones. Question 10. The bid price in a stock quote represents the A. Lowest price a seller is willing to accept. B. Highest price a buyer is willing to pay. C. Price at which the last trade occurred. D. Average of the highest bid and lowest ask. Answer: B. Highest price a buyer is willing to pay. In financial markets, the bid price represents the highest price a buyer is currently willing to pay for a security. Conversely, the ask, or offer, price is the lowest price a seller is willing to accept. The difference between the bid and ask is known as the spread, which represents the market maker's profit. Understanding these terms is fundamental to interpreting market quotes and executing trades efficiently. Question 11. Under FINRA rules, all of the following are typically considered communications with the public requiring principal approval, except A. Retail communications. B. Correspondence. C. Institutional communications. D. Internal memos. Answer: D. Internal memos. FINRA categorizes communications with the public into different types, such as retail communications, correspondence, and institutional communications, each with specific approval and record-keeping requirements. While retail communications often require principal pre-approval, and institutional communications may have different oversight rules, internal memos are generally not considered communications with the public. Internal memos are intended for employees within the firm and are therefore not subject to the same regulatory scrutiny as materials distributed to external audiences. This distinction helps firms manage compliance efficiently by focusing regulatory efforts on client-facing materials. Question 12. Which of the following would be an appropriate investment for a customer seeking income and capital preservation, with a low risk tolerance? A. Growth stock mutual fund. B. High-yield corporate bonds. C. Short-term U.S. Treasury bonds. D. Leveraged inverse ETF. Answer: C. Short-term U.S. Treasury bonds. For a customer prioritizing income, capital preservation, and low-risk tolerance, short-term U.S. Treasury bonds are highly suitable. Treasury bonds are backed by the full faith and credit of the U.S. government, making them virtually risk-free in terms of credit default. Short-term maturities also reduce interest rate risk compared to long-term bonds, further preserving capital. Other options like growth stock funds, high-yield bonds, and leveraged ETFs carry significantly higher risks that are inconsistent with the client's objectives. Question 13. What is the primary risk associated with investing in a variable annuity? A. Fluctuating interest rates on the fixed account. B. Market risk of the underlying sub-accounts. C. Credit risk of the insurance company. D. Inflation risk impacting fixed payouts. Answer: B. Market risk of the underlying sub-accounts. The primary risk associated with investing in a variable annuity is the market risk of the underlying sub-accounts. Unlike traditional fixed annuities, the value of a variable annuity's accumulation units and the subsequent payout can fluctuate based on the performance of the chosen investment sub-accounts, which are typically invested in stocks, bonds, or money market instruments. This means the investor bears the investment risk, and the principal and growth are not guaranteed. While insurance company credit risk exists, the market risk of the sub-accounts is the more prominent concern for variable annuity investors. Question 14. An investor owns 100 shares of XYZ stock. To hedge against a potential short-term decline in the stock's price, the investor could A. Buy one XYZ call option. B. Sell one XYZ call option. C. Buy one XYZ put option. D. Sell one XYZ put option. Answer, C. Buy one XYZ put option. To hedge against a potential short-term decline in the price of a stock already owned, an investor would buy a put option. Buying a put gives the investor the right to sell their shares at a predetermined strike price, thus limiting their downside risk if the stock price falls below that strike price. This strategy is known as a protective put, as it provides insurance against a drop in the underlying stock's value. The cost of this protection is the premium paid for the put option. Question 15. A prospectus is generally not required for which of the following offerings? A. Initial public offering, IPO, of common stock. B. Secondary offering of common stock by an established public company. C. Municipal bond offering. D. Mutual fund offering. Answer, C. Municipal bond offering. Municipal bond offerings are exempt from the registration requirements of the Securities Act of 1933, which mandates a prospectus for most public offerings of non-exempt securities. Instead of a prospectus, municipal bond issuers typically provide an official statement, which serves a similar disclosure purpose but is not legally defined as a prospectus under federal securities law. IPOs, secondary offerings of corporate stock, and mutual fund offerings all require a prospectus to be delivered to investors. This exemption streamlines the issuance process for municipal entities. Question 16. Which of the following describes the difference between the primary market and the secondary market? A. The primary market is where existing securities are traded, while the secondary market is where new securities are issued. B. The primary market involves private placements, while the secondary market involves public offerings. C. The primary market is where new securities are issued to investors, while the secondary market is where existing securities are traded between investors. D. The primary market involves institutional investors, while the secondary market involves retail investors. Answer, C. The primary market is where new securities are issued to investors, while the secondary market is where existing securities are traded between investors. The primary market is where new securities are first issued to investors by the issuer, typically through an initial public offering, IPO, or a secondary offering. This is where the issuing company or government raises capital. In contrast, the secondary market is where existing securities are subsequently bought and sold among investors, rather than from the issuer. This market provides liquidity to investors, allowing them to trade previously issued securities. Understanding this distinction is fundamental to comprehending how capital flows in financial markets. Question 17. What is the primary purpose of the SEC's net capital rule for broker-dealers? A. To obtain a favorable ruling on a new product. B. To ensure all broker-dealer employees pass a background check. C. To establish the minimum capital requirements for broker-dealers to protect customers. D. To obtain permission to use a new advertising campaign. Answer, C. To establish the minimum capital requirements for broker-dealers to protect customers. The SEC's Net Capital Rule, Rule 15C3-1, establishes minimum net capital requirements for broker-dealers. Its primary purpose is to ensure that firms maintain sufficient liquid assets to meet their financial obligations to customers and other creditors, thereby protecting investors and maintaining financial stability in the markets. Question 18. A customer who frequently trades and uses borrowed funds to leverage their investments would likely be engaged in A. Cash account. B. Retirement account. C. Custodial account. D. Margin account. Answer, D. Margin account. A margin account allows investors to borrow money from their broker-dealer to purchase securities, using the securities themselves as collateral. This practice, known as leveraging, amplifies both potential gains and losses. Frequent trading and the use of borrowed funds are characteristic activities within a margin account, as it provides the means for investors to execute more significant trades than their available cash balance would permit. Cash accounts, retirement accounts, and custodial accounts typically do not permit the use of borrowed funds for trading. Question 19. Which of the following is an example of systemic risk? A. A company's new product failing to gain market acceptance. B. A sudden downturn in the entire stock market due to an economic recession. C. An individual bond issuer defaulting on its debt obligations. D. A specific industry facing regulatory challenges. Answer, B. A sudden downturn in the entire stock market due to an economic recession. Systemic risk, also known as market risk or non-diversifiable risk, refers to the risk of collapse of an entire financial system or market, as opposed to the risk associated with any one individual entity or component. It is a broad risk that affects all investments and cannot be eliminated through diversification. A sudden downturn in the entire stock market due to a widespread economic recession is a prime example of systemic risk, impacting nearly all companies and sectors. Other options represent unsystematic, specific risk that can be mitigated through diversification. Question 20. In a municipal bond underwriting, the official statement is analogous to which document in a corporate underwriting? A. Red herring. B. Prospectus. C. Indenture. D. Comfort letter. Answer, B. Prospectus. The official statement for a municipal bond offering serves a purpose very similar to that of a prospectus in a corporate securities offering. While municipal bonds are exempt from the registration requirements of the Securities Act of 1933 and do not legally require a prospectus, the official statement provides comprehensive disclosure to potential investors. It contains material information about the issuer, the bond's terms, the project being funded, and the financial health of the municipality, enabling investors to make informed decisions. Question 21. An investor who writes, sells, an uncovered call option has which of the following risk exposures? A. Limited downside risk. B. Limited upside potential. C. Unlimited downside risk. D. Unlimited upside risk. Answer, D. Unlimited upside risk. An investor who writes, sells, an uncovered call option has unlimited upside risk. An uncovered call means the seller does not own the underlying stock. If the stock price rises significantly above the strike price, the seller will be obligated to buy the stock at the high market price to deliver it to the option buyer at the lower strike price, leading to potentially massive and unlimited losses. This is one of the riskiest option strategies, as the maximum potential loss is theoretically infinite. In contrast, the maximum profit for the seller is limited to the premium received. Question 22. Which of the following entities is responsible for setting rules for all securities firms and exchanges, including those for fair and orderly markets? A. Federal Reserve Board, F for B. B. Financial Industry Regulatory Authority, FINRA. C. Municipal Securities Rulemaking Board, MSRB. D. Securities and Exchange Commission, SAC. Answer, D. Securities and Exchange Commission, SAC. The Securities and Exchange Commission, SAC, is the ultimate regulatory authority responsible for setting rules for all securities firms and exchanges, with its primary mission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. While FINRA acts as the largest SRO for broker-dealers and the MSRB regulates municipal securities, both operate under the oversight of the SEC. The Federal Reserve Board, FRB, primarily focuses on monetary policy and banking regulation, not direct oversight of securities firms and exchanges in this manner. Question 23. What is the primary benefit of investing in a Roth IRA compared to a traditional IRA for a young investor who anticipates being in a higher tax bracket during retirement? A. Tax-deductible contributions now. B. Tax-deferred growth. C. Tax-free withdrawals in retirement. D. No income limitations for contributions. Answer, C. Tax-free withdrawals in retirement. The primary benefit of a Roth IRA for a young investor expecting a higher tax bracket in retirement is that qualified withdrawals in retirement are entirely tax-free. While contributions to a Roth IRA are made with after-tax dollars, not tax-deductible, the earnings grow tax-free, and distributions in retirement are tax-free, provided certain conditions are met. This contrasts with a traditional IRA, where contributions may be tax-deductible, growth is tax-deferred, but withdrawals in retirement are taxed as ordinary income. The tax-free withdrawals in retirement offer a significant advantage for those anticipating higher future tax rates. Question 24. A bond trading at a discount will have a yield to maturity, YTM, that is A. Equal to its coupon rate. B. Lower than its coupon rate. C. Higher than its coupon rate. D. Unrelated to its coupon rate. Answer, C. Higher than its coupon rate. When a bond is trading at a discount, its current market price is below its par value. For an investor to receive the same return as if they had purchased the bond at par and received only the coupon payments, the yield to maturity, YTM, must be higher than the coupon rate. This is because the investor will also realize a capital gain when the bond matures at par. Conversely, a bond trading at a premium will have a YTM lower than its coupon rate, and a bond trading at par will have a YTM equal to its coupon rate. Question 25. All of the following are typically included in a customer's investment profile for suitability purposes, except A. Investment experience. B. Financial capacity. C. Investment objectives. D. Marital status. Answer, D. Marital status. When assessing suitability, a registered representative must gather information relevant to the customer's financial situation, investment objectives, and risk tolerance. This typically includes their investment experience, current financial capacity, assets, liabilities, income, and defined investment objectives, e.g., growth, income, capital preservation. While marital status might be relevant for some estate planning or joint account considerations, it is not a direct component of the core suitability assessment for investment recommendations. The focus is on financial and investment-specific details that directly impact product appropriateness. Question 26. Which of the following best describes a blue-chip stock? A. A stock of a relatively new company with high growth potential. B. A stock of a large, well-established company with a long history of stable earnings and dividends. C. A stock trading at a very low price due to financial distress. D. A stock in a highly speculative industry with significant volatility. Answer, B. A stock of a large, well-established company with a long history of stable earnings and dividends. A blue-chip stock refers to the stock of a large, well-established, and financially sound company with a long history of profitable operations, consistent earnings, and often, reliable dividend payments. These companies are typically leaders in their industries, known for their stability and reliability, even during economic downturns. Investors often seek blue-chip stocks for their perceived safety and consistent performance rather than aggressive growth potential. Examples include companies like Coca-Cola, IBM, and Johnson & Johnson. Question 27. An investor wants to buy ABC stock only if its price drops to $65 or below. Which type of order should the investor place? A. Market order. B. Buy limit order. C. Buy stop order. D. Sell stop order. Answer, B. Buy limit order. A buy limit order specifies the maximum price an investor is willing to pay for a security. It will only execute at the specified limit price or lower. If the investor wants to buy ABC stock only if it drops to $65 or below, a buy limit order at $65 ensures they will not pay more than their desired price, and potentially pay less. Question 28. All of the following are generally true about exchange-traded funds, ETFs. Except A. They typically trade on exchanges throughout the day. B. They are actively managed, aiming to outperform an index. C. Their expense ratios are generally lower than actively managed mutual funds. D. They can be bought and sold on margin and sold short. Answer, B. They are actively managed, aiming to outperform an index. Exchange-traded funds, ETFs, are generally passively managed, meaning they aim to track the performance of a specific index, like the S&P 500, rather than attempting to outperform it through active stock selection. This passive management structure contributes to their typically lower expense ratios compared to actively managed mutual funds. ETFs trade like individual stocks on exchanges throughout the trading day, offering intraday liquidity, and can be bought on margin or sold short. Their primary goal is often to provide diversified exposure at a low cost, mimicking the returns of a benchmark. Question 29. Which of the following characteristics applies to a bond with a put feature? A. The issuer can redeem the bond prior to maturity. B. The bondholder can extend the maturity date. C. The bondholder can sell the bond back to the issuer at par on specified dates. D. The interest payments are variable based on a benchmark rate. Answer, C. The bondholder can sell the bond back to the issuer at par on specified dates. A bond with a put feature grants the bondholder the right to sell the bond back to the issuer at par value on specified dates before maturity. This feature benefits the investor, particularly if interest rates rise or the issuer's credit quality deteriorates, as it provides a way to exit the investment without incurring market losses. In contrast, a call feature benefits the issuer, allowing them to redeem the bond early. This embedded option makes the bond more attractive to investors, potentially allowing it to be issued with a lower coupon rate. Question 30. Under FINRA rules, a registered representative is generally required to complete the regulatory element of continuing education how often? A. Annually. B. Every 2 years. C. Every 3 years. D. Only when changing firms. Answer, C. Every 3 years. Under FINRA rules, registered representatives are required to complete the regulatory element of continuing education within 120 days of their second anniversary of registration and every 3 years thereafter. The firm element, conversely, must be completed annually. Question 31. A customer is interested in an investment that offers professional management, diversification, and the ability to redeem shares daily at net asset value, NAV. Which product best fits this description? A. Closed-end fund. B. Exchange-traded fund, ETF. C. Mutual fund. D. Unit investment trust, UIT. Answer, C. Mutual fund. A mutual fund, open-end fundee, perfectly matches the characteristics described. It offers professional management, inherent diversification through its portfolio, and the ability for investors to redeem their shares directly with the fund company at the end of each trading day at their net asset value, NAV. Unlike closed-end funds and ETFs, which trade on exchanges at market prices that may differ from NAV, mutual funds are priced once daily at NAV for purchases and redemptions. UITs have a fixed portfolio and are not actively managed or redeemed daily at NAV in the same manner. Question 32. What is the capital gains tax treatment for an investor who sells a stock held for 10 months at a profit? A. It is taxed as a long-term capital gain. B. It is taxed as ordinary income. C. It is tax-exempt. D. It is taxed at a special lower rate for short-term gains. Answer, B. It is taxed as ordinary income. For tax purposes, capital gains are classified as either short-term or long-term based on the holding period of the asset. If an asset is held for 1 year or less, 12 months or less, any profit from its sale is considered a short-term capital gain. Short-term capital gains are taxed at the investor's ordinary income tax rate, which can be higher than the preferential rates applied to long-term capital gains. To qualify for long-term capital gains tax treatment, the asset must be held for more than 1 year, more than 12 months. Question 33. Which of the following would not be considered a control person of a corporation for purposes of SEC rules? A. The CEO of the corporation. B. A director on the board of the corporation. C. A shareholder owning 15% of the voting stock. D. A retail investor owning 100 shares of the corporation's stock. Answer, D. A retail investor owning 100 shares of the corporation's stock. A control person, also known as an affiliate, is defined by the SEC as someone who has the power to direct the management and policies of a company, whether through ownership of voting securities, by contract, or otherwise. This typically includes executive officers, like the CEO, directors, and significant shareholders, often defined as owning 10% or more of the company's voting stock. A retail investor owning only 100 shares would not possess enough influence to be considered a control person, regardless of the company's total shares outstanding. Question 34. A broker-dealer's business continuity plan, BCP, should address all of the following, except A. Data backup and recovery. B. Alternate communications with customers. C. Regulatory filing requirements during a significant business disruption. D. The personal investment strategies of its registered representatives. Answer, D. The personal investment strategies of its registered representatives. A broker-dealer's business continuity plan, BCP, is designed to ensure that the firm can continue to operate and meet its obligations to customers and regulators during significant business disruptions. Essential components of a BCP include data backup and recovery, alternative communication methods for clients and employees, and compliance with regulatory filing requirements. However, the BCP does not address the personal investment strategies of its registered representatives, as this falls outside the scope of ensuring the firm's operational resilience and regulatory compliance during a crisis. The focus is on the firm's operations, not individual employee portfolios. Question 35. What is the purpose of a Chinese wall within a financial institution? A. To separate investment banking from retail brokerage activities. B. To prevent the spread of infectious diseases within the workplace. C. To separate proprietary trading from client account management. D. To prevent the improper flow of material, non-public information between departments. Answer, D. To prevent the improper flow of material, non-public information between departments. A Chinese wall is an ethical and regulatory barrier designed to prevent the improper flow of material, non-public information between different departments within a financial institution. For example, it prevents sensitive information obtained by an investment banking division from being used by the sales and trading desks to profit from insider information. This separation is crucial for managing conflicts of interest and upholding market integrity. It helps ensure fair treatment of clients and prevents insider trading by segregating information access.